5-minute tax guides from your 5-minute tax guy. Short lessons to help you navigate the treacherous, hazardous, and totally unpredictable U.S. federal tax code. Okay, I've got to get something off my chest right now before we go any further. Many of you have been telling me, 5-minute tax guy, how come your videos are 8, 9, 10 minutes long? I thought you were the 5-minute tax guy. Listen, when I say that a video is 5 minutes long, what I mean is it's between 5 and 10 minutes long. I thought everybody understood that. You can't explain the U.S. federal tax code in 5 minutes. The U.S. federal tax code is over 75,000 pages long. Take my word for it, I Googled it. And that was in 2014, where the new Tax Cuts and Jobs Act that Congress passed in December, effective for the 2018 tax year, I guesstimate that page count probably went up about 10,000 pages. By now it's probably about a jillion pages long. So if I take an extra 3, 4, or 5 minutes to try to explain it, I think that it's perfectly justified, don't you think? Well, that little rant added another minute to my video. Happy now? Itemized deductions. When completing a tax return, you need to decide if you're going to take the standard deduction or if you're going to itemize your deductions. For most taxpayers, the choice is clear, and even more so under the new Tax Cuts and Jobs Act, which became effective for the 2018 tax year. Most taxpayers will take the standard deduction, but if you're not one of those, then this video will cover itemized deductions so that you can get the biggest tax deduction that you are entitled to. Before we talk about any specific itemized deductions, let's take a look at a Schedule A, which is the form that the IRS uses to list itemized deductions. The Schedule A shown here is from the 2015 tax year, but the one for the current tax year looks almost identical with a few minor variations. Notice that the form is divided into sections, covering each category of deduction, including medical, taxes, interest, charitable, and other. This video will cover only deductions for taxes paid, including state and local income tax, or sales tax, and property tax. You can check out my other videos to get information on the other type of itemized deductions. The list of other videos in this series can be found in the description under this video. Taxes is the second category of deductions shown on the Schedule A. This category includes state and local income taxes paid during the year, or sales tax paid during the tax year, and property tax. State and local income taxes. State and local income taxes include any income tax that you pay to a state or local government. Your deduction may be for withheld taxes, estimated tax payments, or other tax payments as follows. Withheld taxes. You can deduct state and local income taxes with You can deduct estimated tax payments you made during the year to a state or local government. You can deduct any income tax that you pay to any state in the U.S. In addition to income taxes paid to a state, many cities in the U.S. also levy an income tax. And if you paid income tax to any city, town, or other municipality, then you can deduct that tax as an itemized deduction in this category of deductions. Contributions to state benefit funds. As an employee, you can deduct mandatory contributions to state benefit funds withheld from your wages that provide protection against loss of wages. Mandatory payments made to the following state benefit funds are deductible as state income taxes: Alaska, California, New Jersey, New York, Pennsylvania, Rhode Island, and Washington State. Some states such as Texas, Alaska, and Nevada don't levy an income tax, so instead of deducting income tax, you may opt to deduct sales tax instead. You can elect to deduct state and local general sales tax instead of state and local income taxes as an itemized deduction. You can use either your actual expenses or the state and local sales tax tables to figure your sales tax deduction. You can opt to deduct your actual sales tax paid, but that would require you to keep receipts or at the very least record every transaction and the amount of tax paid for that transaction every time you bought a big screen TV or a stick of gum. Instead of using your actual expenses, you can figure your state and local general sales tax deduction using the state and local sales tax tables in the instructions for Schedule A. You may also be able to add the state and local general sales taxes paid on certain specified items, such as automobiles and other large ticket items. Your applicable table amount is based on the state where you live, your income, and the number of exemptions claimed on your tax return. Your income is your adjusted gross income plus any non-taxable items. Deductible real estate taxes are any state or local taxes on real property levied for the general public welfare. Division of real estate taxes between buyers and sellers. If you bought or sold real estate during the year, the real estate taxes must be divided between the buyer and the seller. The buyer and the seller must divide the real estate taxes according to the number of days in the real property tax year that each owned the property. The seller is treated as paying the taxes up to, but not including, the date of sale. And the buyer is treated as paying the taxes beginning with the date of sale. And this applies regardless of the lien dates under local law. Generally, this information is included on the settlement statement provided at the closing. One important thing to note regarding this deduction, and indeed any itemized deduction, to be able to deduct any taxes you paid, you, the taxpayer, must be both legally liable for the payment of the taxes and you must have paid the tax. Let's look at an example. Your parents own a home, but because one of them was laid off from their job, they are unable to pay the property tax on the home when it becomes due. You, being the dutiful child that you are, pay the tax for your parents. In this situation, neither you, because you are not liable for the taxes, nor your parents, because they did not pay the taxes, can take the deduction for the payment of the taxes. Personal property taxes. Personal property tax is deductible if it is a state or local tax that is charged on personal property based only on the value of that personal property and charged on a yearly basis, even if it is collected more or less than once a year. If a tax is levied based on both the value of the property and some other criteria, such as weight or length, then only that portion of the taxes that is based on value may be deducted. For example, if personal property tax is levied on a boat at the rate of $10 per every $1,000 of fair market value, plus $50 for every foot of length. If the fair market value of the boat is $20,000 and it is 18 feet long, then the tax imposed would be $10 times 20, which would be $200, plus 50 times 18, which would be $900, and that would be a total of $1,100. You can only deduct $200, the amount based on the value of the boat. One last thing to note regarding the taxes category of itemized deductions. The new Tax Cuts and Jobs Act, which goes into effect for the 2018 tax year, limits the deduction for this entire category to $10,000. For more great 5-minute tax guides, check out the other videos in my 5-minute tax guide video series. See the list in the description below this video.